Boohoo shares have had a really bad ride throughout 2021, and just yesterday the stock fell just short of 23%, which is a very, very big fall for a company like this. And they're actually down 77% from their all-time highs back in June 2020. So now they are below where they was in the pandemic. And the question being is this price at £1 a share? Is this a good price, or can they go further down? In this video, I'm going to look at the numbers, look at the statements that they've released, or go over the statements that they've released about their profit warnings that they've issued, and just compare it to the competitor ASOS, which is not doing great. But I did look at this one as well a couple of weeks ago, about a couple of months ago, and just compare really, just to see if this fall is overdone and if we could recover from here, or if potentially that's it and the stock's just going to stay at these levels or continue to go lower. It's the 17th of December. My name's Tyrone and you're watching Mini Pip. Jumping straight into the video, the first thing that I actually want to look at is the financials. As you can see, just since recording this video, the last 5 minutes, we've gone from minus 3% on the day to just 0.8, so we've already gained 2% of that back. And I wonder if ASOS has also gained 4.6, and when I last checked, I think it was about 2%. So you can see that as we get into the close on Friday, that these stocks are both recovering. But looking at the numbers, I wanted to look at the half-year numbers that they produced in August, September time, and then I will look at the Q3 update, and then I'll also look at the last few years and compare the stock price now as it was a few years ago. So looking at the first half of the year, they did £975 million turnover, and they did a £63.8 million profit before tax. So there is obviously a tax to pay on that. Earnings per share is down 20%, 15%. So they're making slightly less per share. And as you can see, again, 79.4 million on the previous half year in 2020. So we have seen this decline in profits 20%, but we have seen an increase in revenue 20%. So that's probably down to somewhere in the region, I would say, of costs, maybe supply chains, because as you can see, the gross margin hasn't changed too much. It's only changed 0.4%, which doesn't represent a 20% increase in the profit before tax. That would probably tell me that might be supply constraints, so distribution, which has been a problem for most businesses. So overall, I'm not too concerned on that side of things. And even when we look at the quarterly update that was given, the reason why the stocks fell 22%, it's only on the basis of this one little statement here, that net sales are expected to grow between 12 and 14%, as opposed to the previous guidance of 20 to 25%. Now that is a decline of almost 50%, or depending on how you're comparing it, it is over 50%. In comparison to what they've previously forecasted. So that is you're going to see definitely a decrease in them sales, and again that's also going to affect the profitability, expecting 170 million as opposed to 139 million pounds, which again is a 22 million pound difference. The question being is it really that bad of a, is it that, I mean, look, again, it's up again, but is it really that intense? I don't think so. That's my personal opinion, because if we go back to 2016, all the way up here, 2016 and 2017, which is as far back as the numbers go on the London Stock Exchange, I'll just pull them up, we can see that back in 2017, which is essentially reporting for the previous year, they did £294 million turnover with an operating profit of £30.1 million and a profit after tax of £24 million. So there, I get that the margin is slightly better in terms of the turnover, because if you equate that to what they're doing now, you should see a bigger profitability. But you're not. Needless to say, they have shown insane growth, and I think that if I look at a business that in 2017 had a share price when this was published, and it was published about here, at £1.41, and they're doing £294 million a year, just short of £300 million a year turnover with a £25 million profit. How can it be now that a business that's going to be expected to do £2 billion a year with a £117 million profit be worth the same because it isn't, in my opinion. I think that it's a bit of an overshot from that point on the technical aspect, especially when you include inflation and a few other costs and the size that Boohoo has now grown to. I personally don't think that it is valued that. If we look at the chart though, there's nothing to wrong, or there's definitely nothing to say that it could fall further. I do think that a pound is going to be a flaw in this market for the time being. You can see that previously it was support in October 2016, and if we do break that, we could head down to that 94 pence level. A break below there sees us to 82 and then 58. So I'll just write those levels in. If we do break this current £1.6 level where we're at, your first level is a pound. It is a psychological level. If we break below there, we go to 0.94p. If we break that, we're going towards this level here at 0.82p. And if we break that level, we are heading to somewhere in the region of probably 50 to 58p. And I just don't see a valuation of a business that's worth £600 million, or that was what it'd be worth. £600 million on a business that's doing £100 million a year profit in profit and is a £2 billion a year turnover. It's just doesn't play right with me. But looking to the upside, especially as well, just on that one, especially when you compare it to some US valuations for companies like Nike and Adidas, and they're just insanely valued in comparison to say Boohoo and ASOS. But looking to the upside, for targets, you're going to have probably a bit of tough resistance at that COVID low here, which is about 145, which is a nice 30, well, given it's all over the place at the moment, that's a nice increase on its current level of about sort of 35%, which is fine. The next level of resistance is going to be 179, so that's your next level at 179. And a break above 179 probably sees you head towards that level at £2.15. For next year, I think that £2.15 or this level, this sort of like barrier here, which I'll draw on in a second, is sort of your probably ceiling, which does represent still a 100% increase in its current price. And I definitely think that it could do that. So I think that your floor at the moment is going to be there, and that is just going to be mega tough to crush to the sort of £2 to £2.15 level, which does again represent a 100% increase, and that is really good. So overall, you've got plenty of support below. Looking to the upside, you've got some targets to hit, which I think we'll get there. And I think because the guidance that they've shown, especially on the Q3, they are still going to grow and they're still going to get bigger. And they did highlight, I believe, Omicron was a bit of an issue for them. I can't find it, but I'll put a link to this in the description. But again, Omicron was one of the issues why they've lowered that guidance down. And I think that personally, Omicron is a bit overblown. You've seen it's a lot less dangerous to the original variant, and it's sort of your third shot. I think Moderna said that your third shot, sort of gets it gone. So this is just, in my opinion, overblown, and I think that you're going to see a nice bounce, 20-30%, maybe a bit more of a decline, and then upwards. To the downside, one of the reasons that it could potentially fall is if the general market falls. And given that we've just had an increase in interest rates, there is nothing wrong to say that we could see a fall. But usually at this back end of the year, you have this thing called the Santa Claus rally, and so potentially we might see a recovery there on this Santa Claus rally. But you're going to need the American markets to kick off, which at this current moment in time, they aren't really doing. You've got a lot of them, they are struggling near these highs, which would probably indicate to me that this rally, this potential end of year rally, is either going to be delayed to the last couple of days, because I have seen that before, or it's just not going to happen. But this current price on Boohoo is fine. Same situation with ASOS, just touching on that one. Your support is sitting at £20, also at this current level. And again, if we go back further in the price of ASOS, again, a business that was the same valuation as it was in 2011 is not worth what it is now, given the insane growth that they've gone through. So both of these companies are probably good shares to own for the medium term, and at £1 to £1.07 a share, I'd say it's pretty cheap. That's my personal opinion. It's not a recommendation to buy it, because by all means there's risks, and if guidance is even worse and the numbers do come out next year, this could easily fall down to the 80 50 pence level, and you could be down 50-60% on this one, because I reckon a lot of people bought in here at 185 thinking that it was good, and then you've seen this decline almost 40, 50, 60% from those upper levels here. So just be careful with a stock like this. It has to have investor confidence, and right now it's 50-50. You're probably going to need a rally at the back end of the year to see this do a bit better. Apart from that, yeah, overall pretty good. I'll be doing more videos on some more shares as well throughout next week, and again I'll be posting something on Boohoo on the website, so please like and subscribe, please follow us. We've got free group chats, links in the description below, and thanks for watching.